Well, good afternoon. It's just gone afternoon here to Tuesday, the 23rd of August. We're a little ahead this time. Usually it's the last Tuesday of August, but we have our big conference next week, the BizNews conference. It'll be BNC number 4. And Stuart Lohman, my colleague, and I are going to be in the Drakensberg with another 250 BizNews community members. It's been booked out, but every now and then somebody drops off. So if you want to get to the conference, and I can tell you this is going to be the best one ever, certainly from the lineup that we have. But if you want to come to the conference with us, it starts on Tuesday night, ends, you go home Friday morning, then fill in that form on BizNews or go on to the correct page. Actually, Stu can probably give you a link down the bottom. Yeah, because every now and then we have cancellations. You know, people can't make it because they've got work commitments or they get sick, or there are a few people who've dropped off. But we have actually been fully booked since a month after the last conference. So we were fully booked, and if you wanted to guarantee a booking, the best way would have been to go onto a waiting list, and a lot of people have managed to do that. So it'd be tragic if you want to come and you think, oh, I can't because it's full. Just fill in that form, and who knows, you know, a place may or may not open up. What we did do this time, and it's the only time we're ever going to do this, because in the next conference we'll have chalets available to us. We don't have any at the moment because of the school holidays. But what we did do this time was actually have a day pass. So if you really want to come, there is plenty of accommodation in the Drakensberg Champagne Valley, so you can get there. Okay, that's a long story, Stu. I think maybe we should get on to your side of the business, which is the tech, eh?
Yeah, make sure everyone can hear us, Alec. Just for those new to the webinar, there is a control panel on the right-hand side of your screen. If you get I see the high fives already coming through. But if you can see Alec and myself in a presentation and hear my voice, can you just give me some high fives? There you go. They're streaming it. That's great to see. We also like to keep it very conversational. Alec does run through the presentation, but there's a little question drop-down menu on that same control panel. Please put your questions in there, and then we'll run through them as Alec gets through his presentation. But Alec, all looks good on the tech side, so time to go.
Smashing. And this, as you can see, there was a continued recovery in August. We had quite a sell-off last night on Nasdaq, 2.5% lower. If it had gone up instead, the portfolio would have looked even better. But it's not bad. We've gone back above 20% compound annual growth rate in Rand, and that's well, now it's 7 2/3 years. We started in December 2014. So it shows that if you pick the right stocks and you just ride them, you can achieve excellent performances. In US dollars, the compound annual growth rate now up slightly higher than where it was in the last 2 months, but it's not surprising when you have gone for exponential companies. In other words, companies that grow very rapidly, and as a consequence of that, we've had some pretty big increases over the years from these exponential companies. But there's always bumps in the road, and that's the thing to remember. You will recall that the share prices of exponential companies came under a lot of pressure and bottomed out, it appears, in June. But since June, we've had a healthy improvement in the value of the portfolio. This is a pretty important month to be talking about the BizNews portfolio, because this coincides with the release of quarterly results. And there are a heck of a lot of them to get through. I won't go into lots of detail, but I'll just give you the headline numbers on them as we look through the various portfolios. And of course, what happens is that Stu interrupts. You can't call it interrupts. He participates, stops me from getting on too much of a roll when you put your questions through, and then he'll pose the questions to me. One thing we do on BizNews webinars to keep your anonymity is we only mention your first name. So you'll put through your full name, but only your first name will be mentioned, just in case you got some kind of confidential question that might land you in trouble with your wife or the tax man or whatever. Don't worry, you can ask it in an anonymous manner. Okay, let's go into our presentation from the start. As you can see, August was a really good month. In Rand, the portfolio was up by 8%. Now, the compound annual growth rate of the portfolio since it started in December 2014 is just over 20%. But we started with 2.2 million Rand. It's now 9.5 million Rand. So it just shows you, if you can get consistent growth of 20%, the numbers will confound you when they come to the end. And this is also something that's very, very important on the costs. Watch the costs. South Africans are starting to wake up to the reality of having been overcharged for many, many years. And when you manage the portfolio yourself, you don't have costs that come into the picture in the same way as the big institutions who manage on your behalf will take away from you. And if it's a couple of percent, it doesn't sound like much. But as you can see, the difference in the compounded effect of growing a portfolio, and most of us do invest for the long term, the compound impact is massive. So obviously find the right investments and then also just check the fine print on the costs, because the compounded effect of that is significant. In the last month, though, the Rand value of our portfolio went up by 8%, and in dollars it went up by 6%. That tells you the Rand was a little bit weaker. And both of those outperformed the indices, the S&P 500 4.25, and the Nasdaq 5%. And the reason for that was that the stocks, or some of the stocks that we're invested in, did incredibly well with their quarterly results. There was one that was a shocker, a real shocker. And that's one of my favorite shares, Palantir. When Palantir's numbers came out, the share price dropped sharply. But outside of that, we saw some quite healthy gains. There's the portfolio, and it's nice to look at this. This is in rands. The second successive month, we were going down at quite a rapid pace, as you can see there. In rands, we got to over 12 million, which is astonishing, really, if you think that you started this portfolio with 2.2 million. And it had gone all the way down to just over 8 million Rand, but it's now back at 9.5 million Rand. So again, the message here is just stick with it. Just make your investments, understand why you're doing it, and then have patience, because you do get volatility when you're talking about investing in shares, and actually get rewarded for having the patience to see out the volatility. In US dollars, this is what it looks like. I took it back to November 2019, really to give an understanding of how the pandemic has helped share prices, and clearly our portfolio as well. There was an enormous amount of money that was pumped into the system by governments around the world, but very much by the Federal Reserve in America, to help the economy overcome the lockdowns or the impact of the lockdowns. And it's interesting to contrast this, that what happened in the Western world were the lockdowns were implemented, but because of public pressure, they were not continued indefinitely, as has been the case in China. And also in the Western world, because of the production of vaccines, which has helped the companies producing vaccines a great deal. It's once in a lifetime opportunity for Pfizer and co. But it has been a very good investment, generally speaking, because economies are now back operating at 100%. And you just need to look at what's going on in China to see what the alternative would have been. Okay, so the web trader portfolio, there it is. This is the slide that I put up every month. You can see we are heavily weighted towards Apple and Amazon. Well, add in Microsoft, and you're talking about nearly 70% of the portfolio in those big three stocks. One of the reasons for this is that we bought them a long time ago. As you can see, Apple in June 2015, Amazon in December 2014, and Microsoft in August 2017. So they've been in the portfolio a long time. The view that Warren Buffett has, which we share, obviously, is that you ride your winners. So there would be others who would look at this and say, but you should have downweighted your Apple, Amazon, and Microsoft share. Well, not so much Microsoft, but maybe the other two, which are sitting at 55%. But then all you need to do is look at the experience of Naspers and ask Koos Becker, how many times he was told by so-called experts to sell the 10-cent shares since they were purchased in 2001. And I can tell you it was many, many times. The reason why Naspers is the giant that it is today was because they rode their winners. And we're riding our winners as well. The only time we sell a stock is when we get a insight or a view that there has been a fundamental change, as Warren Buffett again says, and I wrote a book on the guy's investment strategy, so that's really in many ways what this portfolio is based on. What he also says is there's never one cockroach in the kitchen. So when a cockroach emerges, as happened in our case with a company called Metrobank, we sold those shares at £30. They're down at £1 today. We don't always get it right. We sold Tesla when it appeared as though cockroaches were coming out, but those cockroaches didn't. There certainly weren't a lot of them, and Elon Musk has just defied all expectations, and Tesla's gone up and up and up. But those, you can't get it right every time, and that's what investing's about. You learn from your mistakes. If you can see there as well, our fourth biggest stock is Purple Capital. That's up from R1.33 when we bought it in April 2021, so it's about 18 months ago, and it's sitting at R2.17. There was some news from Purple on Friday that they've now gone out of South Africa. They have concluded a significant partnership in Asia. I had an interview with Charles Savage. Charles is going to be at the BizNews conference as well, where he'll be giving us another keynote. His previous keynote got the community very excited, and in fact, the community was bought into the stock at 80 cents, whereas we could only bring it into the portfolio at R1.33. So it looks like the BizNews tribe were the ones who caused our entry price higher than it should have been. But anyway, it is what it is, and it's been a wonderful performer for us already. Spotify financial results came out; they were very good. Zero is the it's been all over the place. I think the reason why Zero is under a little pressure at the moment is it is listed in Australia, so it's lost out on the rebound to a large degree of what happened on Nasdaq or to the American shares. Palantir, we'll talk about that in a moment. The results the market didn't like at all. Meta was added in there in May at the same time as Palantir. Palantir is made for tough times. Meta is a bet on virtual reality going into the future. Both of those were post-Davos purchases. Post-Davos this year, the World Economic Forum was held in May, not January as per usual. And the reason for that was because of Omicron, the virus, the COVID-19 virus that affected things. I went there, met the top guys from those two companies, not Zuckerberg at Meta, but certainly two of his top five, and then Alec Hogg of Palantir. Read through a lot more of their information and was suitably impressed by both of them, and hence they were added to the portfolio and over a period of 3 months. And then there's Transaction Capital and Absa Group, both of those added more recently in June, and reason there was on the back of what? Well, with Transaction Capital, it was largely another reassessment of this company, whereas on my behalf, I've looked at We Buy Cars and really like what I see there, as well as what they're doing in other parts of the economy, the taxi industry. It was really long overdue buying into Transaction Capital, and it had come down to a price point that looked very exciting relative to where it's been. So that was the reason for that. And then Absa, we have to thank Koki Koiman for that increase of 16% since the purchase. The final purchase was was in June. I apologize, on the 28th of June, and that's up by 16% since then. So thank you, Koki. You'll see if you follow the detail of the portfolio, I've been a little slack in adding the dividends, and there were dividends that were paid into this portfolio from Apple and Microsoft, and both of those have now been added to the cash pile, which was, as you can see, just under $1,200, and that was over the last 3 quarterly dividends that were paid. So they're in now, just to give it the proper calculations. The portfolio overall, you can see there, started at 2.254 million, It's now at 9.5 million. And in US dollars, we started with $200,000. That was really the point in December 2014, was to get a rand hedge. And that has now grown to $562,000. So get the right shares, I guess, and it will give you a handsome return if you just ride out the volatility. There's the individual stock performances to date. And there you can see we really have a lot to thank Amazon and to a lesser degree Apple and Microsoft for. Purple Capital has been in the portfolio far less. And the Rand dollar, 51%. Now, it's a little unfair because the Rand dollar, we're going all the way back to December 2014, and it's depreciated by half since then. Interesting to stat for us to look at there. 7 years, the Rand is halved. And some of the others below the Rand dollar, you can see there, Palantir, Meta, recent additions, a little bit softer. Palantir at one point was looking very handsome. And then Spotify and Zero are two wild cards. And you'll see later on, we're going to pick up with a shift portfolio. This is the web trader portfolio, our long one, the one we've been in for a long time. But more importantly, I suppose, in the day-to-day stuff is below there, the month-on-month moves. And you can see some good increases there. ABSA, thanks, Corky, again. The results came out from ABSA, and they justified a rise in that share price ahead of results. Came back slightly after results, but 10% is good going in a month. 10% also for Amazon, and the reason for that increase was completely related to financial results. When Amazon's quarterly came out, the share price actually jumped by in double digits on the day and then went a little higher still. It showed revenue that was up 7% year on year. That's not exponential by any means, but if you consider the base that Amazon is coming off during the pandemic, many people were ordering from home. So you had this massive increase in revenues during the pandemic, and yet in the past quarter, they managed to grow those revenues from that very elevated base. There was a bottom line loss of $2 billion, but that was entirely due to the investment in a company called Rivian, which cost Amazon $4 billion on the bottom line. What the market liked a lot was cloud computing, although it's becoming more mature now. Amazon is the #1 in cloud computing around the world, was up 33% year on year, those revenues. And advertising, online advertising, which is not an area that Amazon is famous for, that was up by 18%. And so the market really loved those results. Apple's shares were up 4.5% after its quarterly results. There was I suppose it's a good reaction because the chief executive expects that sales in the third quarter will be higher, and iPhone sales did better in the quarter than had been forecast. Not by much, but when you beat Wall Street rewards you. The forecast was 2.5%, and they grew at 2.8% year on year. But it's a massive part. Over 50% of Apple's revenues come from iPhone sales. They did warn, though, that the results that were released for the quarter were affected by the shutdown in China and the supply constraints in the whole supply chain. So both of those being good reasons for negativity on the results, yet Apple managed to overcome most of those. So there's Apple and Amazon, our two favorites, doing incredibly well. Microsoft, when its results came out, you might have expected that the share price would take a bit of a hit. It was the first time the company missed the earnings anticipated by Wall Street since 2016, the third quarter of 2016. So almost 6 years since it actually didn't outperform. And as a consequence of that, the share price came back initially, but then recovered. And as you can see, it was up by 7%. I guess this was where people did the re-looked at the numbers, re-looked at the future. And although revenue was down by was $500 million below, these are big numbers, aren't they? $500 million below what market was anticipating. It's clearly something that had already been worked into the price over the long term. And there we have Purple Capital. I've mentioned that. So those four our four best performers are doing pretty well in the past month. Spotify's numbers saw the share price jump 12%. But here's something that's happened. The wild cards did, despite producing some very good financial results, some of them have been really hard hit in the last week as investors in America get a little concerned about the Federal Reserve overdoing the interest rate increases and as a consequence putting the US economy into recession. Palantir deserves a comment. That's down 16% month on month. Well, the figures that came out, and they did exactly the same in May, they warned that they were unlikely to grow by very much in the quarter. Wall Street didn't believe it. The expectation was for $500 million in revenues. Palantir came in at 475, which is spot on with where they projected it. 21% year-on-year growth, still for me exponential, over 21%, over 20% exponential. But Wall Street was disappointed, and then after pushing the share price up, knocked the share price down again. So that's what happens in these markets, and that's why you need the resilience and the ability to just shrug it off. At $8.07 per share, you're now getting a discount of around 20% on when the company IPO'd in 2020. The other reason why analysts weren't that happy with Palantir's numbers was that 21% year-on-year growth is the slowest growth in revenues since the company listed. But Palantir's CEO said the reason for the slower than expected growth was delays in federal government spending. So there we go. But they did the same a quarter before. The share price came down also on a lower than expectations, and then it improved again. It had done it had a similar trend up until the last few days, where Palantir has been under a lot of pressure. Meta Platforms, its financial results for the first time ever, revenues actually dropped. So this is the company that owns Facebook and WhatsApp and Instagram. It produced revenues down on the same time last year. Now that's a worry for me, because you are talking about another Netflix repeat. When Netflix went ex-growth, or in other words, when its subscribers contracted, the share price plummeted. And Netflix is one of the reasons why the Shift portfolio is not looking that healthy, because it was one of our bankers there. And our decision was, there was a cockroach in that kitchen. It would be cousins. And we finally, belatedly, we didn't watch the first cockroach, but we did catch the second one. And after the second one, we sold. Now, Netflix came out with financial results for this quarter, which were better than the market anticipated. And it pushed the price up, but it's a long, long way from where it was in the past. And when an exponential company goes not exponential anymore, in other words, it stops growing at 10, 15, 20%, that's the time that it gets re-rated as a normal company, and that's the time you've got to watch out. Now, Meta, I'm looking at it carefully, because what's bothering me about this was that while the main part of the Meta business is, and remember, this is the old Facebook, that's why it's got an abbreviation there of FB, is contracting. The reason we invested in it was for the promise of virtual reality. But the book that I've read, and I've told you a lot about, those of you who follow this webinar and indeed BizNews itself, Engines That Move Markets, emphasizes time and time again that with a new area like virtual reality being a brand new growth area, it is so hard to pick the winners, so hard. And it goes through motor cars, telegraph, railways, internet. To pick the winners in the early stages is very, very difficult. But I thought I could pick a winner here with Meta Platforms, given that they're so dominant at the moment in virtual reality. But maybe it's time to say, whoa, somebody else can take that chance, because the Meta Platforms results, I didn't like it. You'll know, those of you who've been following this portfolio for a long time, I didn't like what was going on with Oxford Analytics, where they had been abusing data. But I went back in after Davos, after getting terribly excited about virtual reality. Another reason why I'm reassessing this, we haven't done anything this month, but maybe for next month, is getting more and more excited about some stocks on the Johannesburg Stock Exchange. There's some JSE shares here that, although they've performed well, are still looking incredibly cheap. Tungela Resources is one. I mean, the PE on that, you get your money back in 2.5 years. And people are saying, well, that's because there's peak coal prices and they're not going to be able to continue performing at this level. But as long as the Ukraine war goes on, coal's not going to come down anytime soon. So anyway, there are all of these issues that one needs to look at and consider. That's ABSA, I suppose. We have spoken about Transaction Capital had a nice month, and there we go. You can see why this portfolio was up handsomely. Now, there's the individual stock performances. Gives you an idea that once you got a winner, just ride them, and you won't be sorry in the end. And that's the story on the WebTrader portfolio. On the Shift portfolio, as I've said numerous occasions, we bought at absolutely the wrong time. If you go back, 14th of December, the first tranche, 20th of January, the second tranche, 23rd of February, the third tranche, and you can see that the Rand at that time, it was the wrong time for the share prices because we had the worst 6 months for the Nasdaq, which is where these companies are focused, the exponential companies, the worst 6 months since 1939. So you couldn't have picked a worse time to buy the shares. But what is interesting is, although it was the worst 6 months, the loss in rands, with a rand at 17.05 relative to where we bought in, is 15%. Now, if you go through your worst, the worst run in a market in decades, and you're 15% down, well, you can't be feeling too sorry for yourself. In US dollars, down 23%, and you can see this portfolio there. We added Amazon fairly recently, so that's why that one's looking better. In fact, Palantir and Apple were all up just in the last few days. I love the Shift app. I look at it probably more often than I should, which is maybe once a day. And why I like it, it's so easy to see how the portfolio has gone and how your investments have gone. And I own these shares. I own this portfolio. So that's, when you invest here, you're investing with me. I feel your pain. And you can see there that the Investco, which is the exchange traded fund, which is still nearly 20% of the portfolio, has been a relatively good investment because it's only down, well, it's down less than double digits now. And we've had it from the beginning, as with Microsoft. But look at Apple. It's really a solid company there. And Amazon, which we wanted to add, could only add in this portfolio after the share split. And now we've got 28 of those shares. The wild cards, on the other hand, have not exactly taken us to Hollywood. And in the past month, thankfully, there were some of those wild cards that did really well. Cloudflare's financial results came out. You've heard me wax lyrically about Cloudflare. Well, the day after the results, that share price was up 27%. And it's slipped back a little, but at least it's not our worst performer by a long way in this portfolio. The reason for that, it's a great company. Revenue's up 54% year on year. Now, that's what I call super exponential. They've got net cash flow, positive cash flow of $38 million, and they have $1.6 billion in net cash in the bank. And what I liked, or what the market liked about Cloudflare's results, was that in the quarter, they added 212 large customers, the most ever, to take their total of large customers to 1,750. Okay, 212 is a big number. And those large customers generate 60% of the revenue. What is Cloudflare? Internet security world leader. If you want to look for a business that's made for tough times, Cloudflare is it. So is Palantir, which provides data, much of it to governments. So those are our two companies for the tough times, and very happy to have them in the portfolio. The other big jump of amongst these share prices during the past quarter was the results from Uber. And as you can see, Uber down 24% relative to the other wild cards. That's a pretty good showing. And Uber, the reason for that was its quarterly results showed revenue up 105%. The quarter showed positive cash flow from Uber for the first time ever. Now, this is a name that's ubiquitous around the world. If they generate positive cash flow, you got to know that, and it's like that hockey stick effect. Once you break through, you really start delivering good results for your shareholders in the long term. And actually, after the quarterlies, Uber's share price jumped 19%. So what are we doing? We're saying those are good companies. Those are exponential companies. They're still there. Human beings have a difficulty in understanding exponentiality. And what you got to do is overcome that difficulty and stick with them. And we'll see how they go into the long term. Spotify, after a good rebound, didn't do that great. It's still down by 40%. As you saw, month on month, it stayed the kind of level pegging. We were talking about the web trader portfolio. But here, it was a very strong earnings report. Subscribers up 19% to 443 million. It's a lot of people, and they are the dominant player in podcasts, which is an area we know quite well at BizNews, and an area that continues to expand quite aggressively. Paying subscribers to Spotify were up 14% to 188 million in the past quarter. So there we have it. That's the Shift portfolio. Down the bottom, you 1% each in MicroStrategy and Pro shares. 2U, I don't know what to say. 2U's share price dropped again, but it's only 3% of the portfolio. And this is really weird because 2U is subjected to a takeover offer at $15 a share, and it's trading at $7.50. When the takeover offer was tabled, the shares went up to $11, but now they've just, maybe lack of interest, down to $7.50. MicroStrategy lost its chief executive. Well, he's become the chairman of the company now, Mr. Saylor, and he's the guy who had a huge bet on Bitcoin, and we were buying the MicroStrategy shares on the strength of it trading at a big discount to the underlying Bitcoin shares. Well, that didn't really help much because Bitcoin, as you can see, the Pro Shares Bitcoin ETF down 54% in the past, since we bought into it over those periods, December, January, February. It showed a lot of life going back to $25,000 a Bitcoin. And of course, that will push the ETF and MicroStrategy shares higher. But in the last few days, Bitcoin has come back to around $21,000 again. But we've got 2% of the portfolio in Bitcoin through MicroStrategy and the ProShares ETF. And that's about right if you talk to the experts, the guys who know these things. They say you got to have some exposure to Bitcoin, and we're quite happy to have that. So, Stu, I have rabbited on quite a lot. I'm sure that there's the people who want to maybe give us a little bit more explanation. There's all our contact details, I suppose, but mine directly.
Thanks, Alec. You mentioned Tesla earlier. Anthony just wants to know, do you think it's too expensive now still?
Tesla is one of those shares, Anthony, like Transaction Capital, like Amazon, like Apple, that you can always make an excuse for it being too expensive relative to where it's come from. Tesla is the one stock that I'm really sorry we haven't got in the portfolio yet. I keep looking at it, and it's almost between. Remember, what we do in this portfolio, we can only buy and sell once a month, one day a month. And so between portfolios, I've seen Tesla go down to $600 between dates. And then I'm really keen to finally buy some, because especially in the Shift portfolio, we can sell the ETF. The ETF, the 20% that's in the ETF, is there specifically to be reallocated to individual shares. But then you get to the end of the quarter and the end of the month on webinar day, and the blooming share price is back at $8.50. So Tesla is one of those that will always look expensive. I guess the thing to do, it's a great company. You know that Elon knows exactly what he's doing. You know that everyone in America knows who Elon Musk is because of his entrepreneurial expertise. And if you believe in his strategy and in electric cars into the future, and there's no reason why you shouldn't, then just wait for that share price to come back to a level that you're comfortable at. And indeed, in the 600s, it's got to be one that you would be buying into your portfolio. So, yeah, at the moment, 869. Just looking at the share price graph, it did come back a little in the last few days, but in fact yesterday it came, but so did most of the market. But the stocks, just in the last 3 months, you'd have been paying nearly $950. You're now paying $860. But I like it when it's below $700. That's if that happens in one of the webinar days, you can be sure we're going to be buying in.
Alec Schwab just wants to know, he says, with the potential grey listing of South Africa, do you think this will affect the JSE and potentially the GDP?
It's horrific. And this grey listing, I've got a friend who explained the whole thing to me over an informal discussion. And I've asked in the interviews with both Sim Shabalala and Mike Brown in the past week, I asked them about it. And they're concerned. They're very, very concerned. It will increase the cost of capital for South Africa significantly. And when the cost of capital increases, that has to increase or decrease the value of the companies who are exposed to it. So it's a big, big concern, but and actually as big as a rating downgrade, an investment rating downgrade. I'd urge you, if you're interested in that subject, to go along and listen to those interviews with Mike Brown and Sim Shabalala and get their views. They especially Mike explained it incredibly well. He unpacked it in a form that I could understand. He used the analogy of a relay, and how the first runner is the regulation, and the second runner is the application, and the third runner is catching the guys who are naughty. And he said that's where we're falling down. We've got good regulations, but we are applying it, but we aren't catching the guys who've been naughty, and we certainly aren't in the fourth runner. I think he said was putting them in jail. We haven't been doing that in South Africa. So we know there's I was reading a book by Outer, really good book that goes back into the whole state capture issue. One of the Outer, not Wayne Duvenage, one of his colleagues wrote this book, and it's amazing how many people have done blatantly dishonest things in South Africa, been exposed for it, but never gone to jail. And you can do that if it's politics and within a political environment. But when it comes to financial services, you don't wrap the people properly, and you don't show that there's retribution for misbehavior, then you do get punished by your global peers. And that's the situation we're at the moment. Very, very scary. Something else in that book, just as an aside, the ANC had an investigation back in 2016 into state capture, where it said absolutely not, and how dare the rest of you even consider that state capture could happen in this country under the ANC's watch. Well, we know what that was about, don't we? So I'm scared. I'm worried about the grey listing. I think we all should be, but hopefully sanity will prevail, and we'll have a couple of big fish put into jail, and the international community will say, okay, South Africa's getting its act together.
Thanks, Alec. Anthony says, hopefully the Tesla share split will make it more affordable, because I think that's also in the pipeline.
Yeah, it will. We could have bought a share in 600 or 700. We could, but with Amazon, for instance, when that was sitting in the over $2,000, we couldn't put that in the Shift portfolio. Let's just wait. It's nice to wait for these things because the market's got a way of rewarding you if you're patient.
Colin just wants to know, if you had any spare cash now, where would you add?
Sure. Cloudflare and Palantir. I'm just looking. I mean, I really call me nuts, but Palantir to me is just a fantastic company with its data. It's got new products that are that it's invested massively in bringing them to market. The market investors don't like it. It's not politically correct. Peter Thiel and Alex Hogg are not your guys that are going to get invited to the Democratic Party's next conference to speak there. But they run a really good show. And Cloudflare, it's just my favorite stock. So those would be the two that, for me, that I'd be happy to add to.
John just wants to know if you have any comment on Process. Is Tencent post exponential growth, and the other Process investments that seem rather average? Is it hold or sell?
Yeah, John, that's such a good question, and I think it's occupying a lot of minds of these of the investment specialists, guys who make a living doing investments. As far as our model portfolio is concerned, and I said this last month and the month before, I was very sorry that we missed the obvious opportunity to buy into Naspers and Process at a time that they were sitting at massive discounts. If you recall the story, let's just use Naspers as the stock there. The story there is that Naspers in 2001 bought 50% of a 32-person firm in Hong Kong for $32 million. And they then, over the time, the company was listed. They had to dilute down to in the 30s. And this was Tencent, which has become one of the mega companies around the world. So it's been described as the best ever private equity investment. And what Naspers did was that they sold a few Tencent shares and then reinvested that in bets that they wanted to make. Their management felt were good ideas, because you can never really repeat a Tencent, but you can invest in areas that are similar, that will grow with a bit of patience, that if you water it properly. And they've got some of those. They have classified ads where they, I think, #1 in the world in most areas, online classified advertising. And they're also very big and very heavily invested. And this is where the criticism comes in food delivery, because food delivery just isn't making money. And the biggest food delivery service in China has just gone bankrupt. So that's the concern that many of the South African investors had, was that Tencent shares are being sold, and they then get used by Naspers to invest in bum areas. That's, putting it very crudely. However, what we all seem to miss was that maybe that's the case, and maybe management aren't that great, but that doesn't mean that you should be trading at a 60% discount to what your Tencent shares are, because at some point in time, you're going to work out that if you aren't prevented from selling those Tencent shares, there's an obvious discount that can be closed there. And on top of which, as the point that you've made, Tencent has just brought out its first quarterly results where it went backwards. Its revenues went backwards, a bit like Meta, where, is Tencent a exponential company? Still not so sure, because exponential companies are supposed to grow at 15-20%, not go backwards, or not have revenues that are reduced. Why? Well, Tencent is getting hit by the Chinese government effectively, which has changed its mind about entrepreneurship, and it's become a lot more politically driven, that whole regulatory structure. And we've been talking about this, or writing about this on BizNews for some years now, since President Xi went into that mode. So for us, Tencent as a direct investment, not so clever. But you're still sitting at a big discount between Naspers and Tencent. And what changed there was that Tencent has now said to Naspers, it's fine, you can sell as many shares as you like. Up until recently, Naspers was unable to sell shares in Tencent unless agreed. And what they did was they sold 2% for 3 years. They wouldn't sell anymore, that kind of thing. Well, now they've got this treasure chest. They're trading at a big discount, and they can sell as many shares as they like. The contraction of Tencent's revenues means that you're not going to get that continued upward growth that you've seen for so many years from Tencent. So you could imagine that Naspers will be selling more and more of these shares because they would take a view on it, and now they're allowed to. And on the other hand, Naspers is still trading at a 30% plus discount to the Tencent share price. So what you've got here is a battle now going on between how quickly can you sell the Tencent shares to contract that discount. But there's enough of a discount in there to suggest that you're not going to lose money on Naspers. And indeed, if you have a look at the price at which they've been doing share buybacks, it gives you a pretty useful floor if you're going to buy into that company. Of course, the wild card in all of this is what happens if the bets that Naspers has been making do return or do achieve the returns that Naspers' management says they have been. Because they look at an IRR on their investments, and they're putting that number at 20% a year, which is excellent. The problem with that is a little bit like there was a company called Corp Capital, which inflated its earnings one year because of an investment that it had in an internet company, which was like a shooting star. And the following year it went down, but it inflated its earnings so that management could actually take big profit shares and pay themselves more handsomely. So, and that was a big scandal, which led to the resignation of the chairman because he didn't like what was going on, Nick Frangos, and all kinds of other fallouts. You can, I don't want to say fiddle the books, but it's much easier to play with those numbers in unlisted companies. And many of Naspers' bets are in unlisted companies. In its listed companies, it hasn't been doing that well. And you just go and look at Delivery Hero, for instance, in Germany, and thank heavens for Naspers shareholders, they didn't win the bidding war for Just Eat in the UK, because that's fallen by well over 50%. So there are all of these moving parts in it. But if you like the company and you like where they're investing and you own the shares, at least now you've got a bottom, you've got a floor, and that, I guess, in these uncertain times, would make them worth holding on to.
Thanks, Alec. I know Sasol's results came out early, and you are going to speak to the CEO later today. But Shah wants to know, where do you think it could end up? I know they've just gave the first dividend this as a payout today after 3 years. But yeah, your thoughts on Sasol?
I'm not going to say anything until I've had a chance to talk to Fleetwood. I do think that our discussion is going to inform my understanding of it a lot better. So please forgive me if I pass.
Thanks, Alec. Sarah just wants to know your thoughts on semiconductors. She says, I've seen some views that they are likely to drop drastically post a good run in recent years. Do you have any views?
The semiconductor market is so interesting, and I've been following it not intimately because we don't have any of those stocks in our portfolio, but as an interested observer. And you're well aware, Sarah, that President Biden has taken a view that America needs its own. It needs to be producing its own. And I think the number was $51 billion of subsidy, $51 billion of subsidy that is being voted now for the semiconductor industry. That's a very, very chunky little bit of support for you. On the other hand, the reason why Biden is supporting that industry, and that's the Intels, etc., is because of a concern of what's going on in Asia, where Taiwan is now being laid claim to by China. It always has laid claim to it. And the history there was that Chiang Kai-shek, I don't know how many years, 80 years ago, when he was defeated by the communists, Mao Zedong, in China, he and his nationalists, as they called themselves, hopped off to the island of Taiwan, and they created a republic there. And the communists have always said that that's part of their country, and they want it back. And the Chinese look at things in terms of many decades, not just a few years. Recently, they warned the Americans when Nancy Pelosi, the Speaker of the House, visited Taiwan not to go beforehand, but she went anyway. Then they buzzed, they sent a few jets in there, and they had a military exercise to blockade Taiwan, and it was quite a tense period. But it's likely that the political issues that are going on in China, this is what you hear from a Gideon Rachman and some of the guys who specialize in this, our partners at the Financial Times, is such that they don't really want to have a full-scale invasion right now. I think also that saber rattling came on the back of the Americans pulling out of Afghanistan. But Taiwan's a very different kettle of fish for the Americans, on top of which Taiwan are a huge semiconductor producer. Most of the semiconductors in the microchips in the world come from Taiwan. So it's like if you're invested in microchip companies or semiconductor companies, silicon chip companies, then and they're based in the United States, it's a bit like what you're looking at with Naspers. You've got a floor, you've got a support base from the government because of in this case, the geopolitical situation. So I don't know. You do your homework, you check them out. If you like them, if you can see if they fall within your price range, and you do your projections going out, always use a spreadsheet, because it's hard with rapidly growing companies to understand the impact of exponentiality. I mean, just look at this portfolio as an example. You've gone from a rand amount of 2.2 million to 9.5 million, and the growth rate there is 20%. I promise you say if you go 8 years into the future and you invest 2 million rand, what do you think it's going to be worth at a 20% growth rate? Our heads would say maybe double, but of course exponentiality is so much bigger than that. So do your numbers on your spreadsheet, I would suggest, and then take a view.
Anthony just wants to know, can you comment on the difference between ABSA shares and the ABSA preference shares?
Yeah, the one is equity and the other one is a loan. So preference shares, they don't rise when the economic value of the company improves. You're buying a preference share simply for the dividend that is paid every year. And usually with prefs, some of them continue indefinitely. It's like buying a bond. It's like ABSA borrowed money, and many of the banks did this. They borrowed money through preference shares at a time that the interest rates were low. So they locked in a pretty cheap source of funding. But for ABSA you can buy preference shares in ABSA, First Rand, Standard Bank if you're looking for a fixed income, but you won't get any capital appreciation unless interest rates move in your favor. But then it's very small relative to equity, where you get full-on capital appreciation. That's really what you're buying into. Something else with ABSA is you're also getting a really good dividend yield there. I think it's around 6% at the moment.
Thanks, Alec. Andrew just wants to know, what's your investment process? He says, do you have a screener? I'm not sure what that means.
No, I'm not an asset manager. I'm not a money manager. I'm not John Bickard or Piet Viljoen or any of these guys Sean Pesh, who do it for a living. This is a model portfolio. This is just an intelligent layperson's look at things. What I do personally is I like to have an intrinsic value for the share. So I just apply the stuff that Warren Buffett tells us to do. And an intrinsic value is worked out. You read that book of mine, you can get it online at Amazon. I'm not talking about the hard copies, they're out of print, but you can get the electronic copy. And it's quite a simple process if you've got an Excel spreadsheet, I suppose Google Sheets as well, where you put in what you think the company will grow at over the next few years, and then you work back on what it should be worth today at that growth rate. And that gives you an intrinsic value, which can be massively different, but at least it gives you a feeling and a guide for where you think that there is value in that share. So that would be my screening process. But I don't have like 100 shares that I watch or 1,000 shares that I watch and take it through a quant type of process and then come out with numbers at the bottom. What I do is I look at sectors that I understand. I understand the media sector. I've been in it for 40 years, so it's the one sector I do understand a little bit about. And then C, the kind of companies that we use as a business at BizNews, and their products are excellent. Cloudflare is a good example of that. Spotify is another good example of that. Then I go and read the annual reports and listen to the comments. Daniel Ek at Spotify is a phenomenal intellect, the founder of that company, a bit like Steve Jobs from Sweden. And then after that, you wait for the share price to get into a range which fits your intrinsic value, and then watch it. And just buy it and watch it. You know, Amazon was a really good example. My first company that I listed, well, the only company I ever listed, MoneyWeb, was listed in '99. So it was right at the peak of the internet boom. And we all looked to Amazon then as being the flag bearer. And when the NASDAQ collapsed, Amazon dropped to about 5% of its value. But it didn't make it a different, the share price dropped there. It didn't make it a different company. It was still an amazing company. And when we bought into Amazon in this portfolio, I recall that it fell after our purchase. But Jeff Bezos was still Jeff Bezos, and everything that you can consume of his, and he's a little bit like Warren Buffett in that he writes an annual letter to shareholders. I love that. I love that. Yanni Moton used to do it here in South Africa as well. That is such a big tick. If you get a letter from somebody and you can read what they say and you can see the clarity of their thinking, and you then apply it to business, it very quickly sorts the wheat from the chaff. What I love about Apple is that it survived Steve Jobs, who is also a once-in-a-lifetime person who comes along. Tim Cook's doing a fantastic job there, but he was selected by Jobs to succeed him, and so on. Microsoft there was a different reason there. The products aren't as good as Apple products, and you know, Microsoft people will a little bit like the Toyotas and the Land Rovers. They won't agree with that. But the products, even though I believe that the products aren't as good, what appealed to me about Microsoft was when they changed their model to an automated company model, where they got automated billing, where you pay them every month, and the automated customer experience has been very, very powerful for companies who sell into the retail market. And instead of having to every time work out to sell once a year, they get sold on a continuous basis, and so on and so forth. So I hope that kind of helps a little bit of the way I look at it. But it's things I understand and things I know, rather than taking a guess on stuff that I don't. ABSA, I used to be on the executive ABSA, so I know that bank quite well. I know a little bit about banking as a consequence of that as well. But, it was many years ago, and it was my only break from journalism. But when I look at ABSA, I got a good feeling of the underlying base there through the mortgages. It's a very powerful franchise, and it hasn't been well managed for some years. But the new managers are good. They're really, really good. And you're seeing that now being reflected in the share price.
Thanks, Alec. I'm not sure if you remember, we did an intrinsic value webinar back in the Houghton days. And I've just put the link
Brilliant.
up on the chat control panel. But yeah, in that little office we built.
When were the Houghton days? That's good. when we worked out of our house in Houghton before we went to the UK. Jeepers. So we're talking 2014, just after BizNews started, 14, 15, somewhere around there. Yeah, it's well worth watching that. Thanks, Stu, for doing that and remembering that. It's well worth watching that video.
Thanks, Alec. I see we've come to the top of the hour, so I think we can probably leave it on the intrinsic value comment. So yeah, thanks again as always for the hour of your time.
No, and thank you, my friend, and thanks to our community. Thanks, guys, for coming along, asking the questions. Please remember that this portfolio is an intelligent layperson's view of stocks. It's not, I'm not a money manager. You can't decide that you're going to put your house on what Hogg thinks, because that would be just silly. But what I do want you to do is to use this as a basis for your own homework. So do your own investing, because nobody watches your money like you do. Honestly, nobody cares about your cash like you do yourself. And if you can do that and you can start learning more and more of the process of investing, it'll be an asset and a skill that will repay you many, many, many times into the future, apart from just opening up a whole new world of interest. I mean, I wake up every morning fascinated at what's going to happen in the markets. And that's why we have the BizNews briefing, which is a report. We've changed it a little bit, but you can pick it up around 6 o'clock in the afternoon now, which tells you what's happened in the day and gives context of it, because it's fascinating. And that's what we'll continue doing. Hopefully, we'll remain fascinated, and in that way, we can share our fascination with you. But thanks again for coming and for your support, especially as BizNews Premium members. It really provides the base to our endeavors, and we appreciate when you show your support in this way.
Thanks, Alec.